Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is Monday, March 13th, 10:30 a.m. in the UAE. Early trading in Asia seems rather dull. We've had the second and third largest U.S. banks ever to collapse, and the oil markets are kind of like, what's next? What's going on? Let's go straight to America, to Mike McGlone, Senior Commodity Strategist, Bloomberg Intelligence. I know, Mike, you've probably been up 48 hours now all weekend tracking this story just for us, hot off the press. What's going on?
Well, you see that they're planning on bailing out all the banks. The key statement I got was the Fed also announced a new bank term funding program. FDIC said it would resolve SVB in a way that will fully protect all depositors. And that was a key thing I read this weekend, that only about 90%, about 10% of actual all deposits were protected up to 250. The key thing I'm noticing in markets is, yes, crude oil's doing nothing, but that tightening we had priced into the market, it was up to, for the next meetings in March, was up to 50%. Now we're about 80%. They're going to get 25 basis points. And the key thing I was really noticing is last week, before this came out, markets were looking for a peak in Fed funds in June around 5.5%. Now it's around 5%. So markets taking a significant amount of tightening out of the market. And that's the key thing, is the fact that the Fed is still tightening. And to me, that's the bottom line that's happening in all this space. Is what you're seeing is just part of the trees in the forest. The forest is the Fed is still tightening aggressively. Almost everything that SVB and Silvergate had in common is they were holding longer duration treasuries than they should have, and they lost in that part of the portfolio in addition to their other assets. So to me, this is just part of, this is in my view, this is a tree in the forest, and the bigger picture for us is the things I've been talking about for a while. Is we have a pretty significant situation, economic activity is going to be declining, and it's all really in the back of the most aggressive central bank on a coordinated basis ever.
Omar Najia, Global Head of Derivatives, BB Energy. Omar, why do you and your peers not really care too much about this news over the weekend? It has had little impact on the oil markets. What does that tell us about the oil markets?
I mean, it tells you basically that other markets, I mean, this stuff is traditional now. It's like, you go to Saudi Arabia, you do a sword dance, you listen to the Fed, they do a bailout, right? So it's I mean, what's new? I mean, it's exactly the same thing, right? They've been doing this since 2008. Always the same thing. Don't worry, everything is okay, blah, blah, blah. So you got two things happening. You got basically the people who tell you that everything's okay, it's like everything's perfect, like the Goldilocks kind of thing. Either we have a really soft landing, feathery kind of, or no landing at all, just keep going. Everything's fine. So basically what you should be doing is buy stocks and off we go, and all is good. The Fed has it under control. Okay. Wheel falls off, something goes belly up. Don't worry, we print more money, off we go. That's one side. The other side is the bond market, which is by far the bigger market. But the bond market's telling you it's all crap. We're stuffed. It's going to get even worse. The Fed can't do anything about it, and everybody's going to basically, pay through the nose for the stuff that they have, right? So everybody who's got, so let's take stuff to do with collateral, right? So I borrow $1 million from you and I tell you, look, I've got collateral and look at these lovely bonds. They're amazing bonds. They're paying me 3% or whatever it is. Basically, I bought them when interest rates were at 0. Now these bonds are worth very little indeed because interest rates are up. So they're yielding a lot less. So or basically people will buy them for a lot less. So collateral. So you've got systemic issues with financial markets, and basically you've got the Fed and Western central banks that can only do one thing: bailout, print money. It's like that adage that when you got a hammer, everything looks like a nail. Meanwhile, the oil market is just going sideways, which means it's kind of building energy, and it's going to break out. the longer it stays sideways, the bigger the breakout's going to be, or the more violent the breakout's going to be. I think, for my sins, that the breakout's going to be to the downside, not to the upside. I think the same of the equity markets. And I think basically we're not heading for a good place. I think it's, I think the stuff that happens. I mean, there's supposedly people who are regulators who are looking after making sure that this stuff can't happen with banks, right? Maybe those are the Yellens of this world and all the rest of it. So it's quite interesting. They're doing nothing, right?
Yeah, Neil Atkinson, former head of Oil Markets Division, IEA. Neil, your thoughts on whether this, when all is said and done, a bullish event for the oil markets or a bearish one? Bullish in the sense that it could signal the end of rate rises. Bearish, it could signal contagion and, Armageddon.
Well, I mean, I'm a PES optimist, I suppose. That we got some mixed signals. But let's address perhaps more directly the language that Omar used about violent breakouts, oil more likely to go down than up. There's a lot of sense behind that, but I'm not sure I necessarily agree for these reasons. Number one, as far as the oil market itself is concerned, dull is good. I like dull and boring. When I used to work in PDVSA, we used to yearn for days when the markets would be peaceful and prices weren't oscillating all over the place. So I don't think it's necessarily such a bad thing. But Omar is right. There could be a violent breakout. Now, this week, the agencies, the IEA, OPEC, and others are putting out the latest editions of their oil market outlooks, which will be giving us updated data on some of the key indicators, particularly Chinese demand, which is still pretty opaque, and the picture will start to clear up. If, for the sake of argument, because of the lower than expected GDP growth outlook for China that we heard about recently, does turn out to be accurate, then the prospects for oil demand growth in China are less rosy than we might have thought. And because of the continuing strategy on the part of the Fed, which Mike was talking about, it could well be that the rosy outlook for global oil demand in 2023 will not be maintained. At the same time, it does look likely on the supply side, I believe, that Russia, by one means or another, is going to be able to supply more oil to the market than we might have expected. So I'm perfectly happy to buy into the view that the market is likely to stay dull and boring for a while. And I don't see there being a violent breakout. I mean, it's the analogy I was talking about, it's like the buildup of energy in a storm and then suddenly it breaks out. I don't necessarily see that. And I actually think the market is going to tread water until there are very clear signals as to whether or not China's demand growth is strong, the global oil demand outlook is strong, and until we see what's happening with Russia.
Mike, coming back to the US, I mean, we've had, some of the points made by Omar and Neil there. We've had, obviously, the SVB bank, the Silicon Valley Bank collapse on Friday, and then they closed the Signature Bank in New York yesterday, Sunday, which is a crypto bank. So you've got the wackos in Silicon Valley. That's really unique. And we got the crypto wackos. So these are two really contained, unique little situations. There's no contagion here, but we're still going to bail out all of the depositors well beyond the legal requirement of $250,000 by the federal insurance. What does this tell you? Contagion risk or not?
Oh, absolutely. These are just small trees, and it's the fastest horses in the race going down fastest, going down first. I remember this is on the back of the most severe, sharpest, aggressive Fed tightening schedule ever. In addition, on the back of that, the rest of the world, with two key exceptions, that's Japan and China, because their economies are struggling. And to me, this is just the beginning of the greatest, one of the most significant global macroeconomic resets of a lifetime. So I fully expect crude oil is going to follow natural gas and head towards 40. I think it's going to break down. I mean, it's just the way things work in this case. The U.S. is clearly heading for a recession. And key thing is, it's still ironic. The Fed's still tightening.
Well, we have Goldman Sachs overnight saying they expect the Fed hike for this month not to happen now.
There you go. So there's the key thing I've been pointing all along. The number one thing that'll stop that from happening are markets. And markets will take that out. Now markets will switch to ease. So by this time, the key thing is that you look at it a year from now. A year from now, I think we're going to be talking about severe, extreme deflationary forces on the back of the tightening, on the back of the biggest pump in liquidity in the history that's dumping. And we're seeing that happen. These are just a few banks. The key thing is you look at the US, there's very little incentive for anybody to hold money in banks anymore because they're not paying any deposits. That flight out of banks is pretty severe. So they're going to have to protect them all, or banks have to raise rates, which means the economy shutting down anyhow. It's already just key thing is the market's been focusing too much on the lagging indicators like unemployment. Unemployment always trials in recessions, and it's a stated goal of the Fed for unemployment to rise. So I think this is part of the big correction, might be worse than 2008. You're seeing it bounce overnight, but that's the key thing. Remember about markets and bear markets is they will rip your face off and take money for everybody and eventually go down. So here's my take on it. If you look at the 10-year note yield around 4% last week, it got there. Copper was around $4 per pound last week. The S&P 500 divided by 1,000 was around 4. I think they're all more likely to go to 3 than 5. And that's just normal reversion in a bear market, in a recession, and that's where we're heading. The bottom line is we have a pretty significant inverted curve. The Fed's still tightening. They might not tighten anymore, but it's here's the thing to end with, Sean. This week marks a 1-year anniversary. So remember the rules of long and variable lags. They're just starting to feel the effects of this aggressive rate hike schedule.
Did these banks do anything that was kind of out of their performance level? I mean, it seemed the Silicon Valley Bank bought what seemed to be safe government debt. Exactly. I mean, my question ultimately is the bank rewarding bad behavior here by bailing them out?
So that's the difference with what's happened with some of the past bailouts. A lot of their assets, particularly, I don't know so much about the latest, but Silvergate and SVB had a lot of their assets in safe U.S. treasuries, but their durations were too long. Now we had the sharpest rate hikes ever. We had the biggest bond collapse in history. And that's where they're losing a lot of the reserves. Of course, they're losing on the asset side too, but these, those are, it's not so much bad speculative behavior. It's just the Fed raised rates so high, bond market prices dropped so fast, and unfortunately they had to liquidate, and sometimes they obviously didn't hedge. So to me, this is the macro. And when you have the bond market collapse that fast, and I'll think, and with this, the U.S. Treasury market's the most leveraged market on the planet.
Omar, the other big story that kind of got smothered this weekend because of all the noise about the bank failures was the rapprochement between Saudi Arabia and Iran agreed to reopen diplomatic relations and whatever associated kind of détente that would come with that. Your thoughts on that as an event for the region, event for the markets, relevant, not relevant?
Yeah, I think basically geopolitically it's massive. So it's absolutely ginormous. So that's why it hasn't been, given like the hurrah, ticker tape kind of treatment. But it's massive. So basically, Iran and Saudi have done this rapprochement deal brokered by China. So the US is left on the sidelines looking silly. Israel is terribly unhappy, and it's a disaster geopolitically for the US, for the whatever you want to call it, for the system. And you still have, like Mike was saying, these problems in the US, and the biggest, I mean, you can forget about the West is basically the US. There is no, Europe is all nice and whatever, but it's like an appendage. So the US has massive problems. It's not just economic, it's now geopolitical. They've got problems in Ukraine. They've got problems geopolitically with the global South, with everybody. With sanctions, nobody's towing the sanctions unless they're, the European, the golden billion, blah, 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 blah. And it's a disaster on every level. So the only question in my mind is not if, but when we're going to see basically this disaster hit us. When are we going to start seeing everything start to puke. Everything start to puke. I think basically, I mean, you've had this idea since 2008 that you can print as much money as you want and nothing matters. Inflation, we'll never get inflation. Now you have basically massive inflation. You have massive interest rates. You have government debt, never been any higher. You have corporate debt, never been any higher. You have consumer debt, never been any higher. You've got basically bits start to fall off, and still, it's like everything's fine. We will do just okay. We'll just keep moving along gently, and there's nothing to worry about. So yes, very possible. But what I'm trying to what my point of view is that there is coming a point when this thing is going to break extremely hard. Either
so the deal with Saudi and Iran is obviously important because of the regional piece, but you're highlighting that it's also really important because it was facilitated by China.
Big time. So basically what it's telling you is the old world order is finished, absolutely finished. So you had the US, our biggest ally, the petrodollar, all that out the window, completely out the window. But people don't want to see, because they're so used to everything being the way it was and it's always going to be the same. They just don't want to accept, which is why when it breaks, it's going to break massively, because everybody's still in the mindset, we're okay, just, we keep kind of moving along and everything will be fine, blah, blah, blah. That is, so nobody's kind of worried. Nobody's screaming. Nobody's saying, oh, fuck, what are we going to do? No. It's all like, everything's perfect. So I think basically that's why this sentiment to the downside is going to build. It's quite scary. So let's see what happens.
Neil, the other news over the weekend, which again sort of passed without much notice because of the dominating headlines from the US, was a report from Bloomberg saying that India will now not breach sanctions by Western countries on Russia's oil price cap of $60. Not on the record, but Bloomberg reporting sources familiar, as they call it. Does this strike you as significant or not?
Well, superficially, I suppose it does. But I think from the point of view of anybody wanting to punish Russia, in some respects, the damage has already been done, because India has hugely increased its shipments from Russia from next to nothing in 2021. I think 50,000 barrels a day on average for the year as a whole. And at certain points in the later part of 2022, the shipments have gone up to 1.2 million barrels a day. So, is it significant? Well, probably not that much, because there's still going to be huge volumes of Russian oil heading to India over time, because it's an unmissable commercial opportunity for India. So I'm not placing that much importance on it. It comes back to my theme that a lesson that we have learned in this past few months. I know we're talking about anniversaries. It's just over a year since the Russian invasion. At that time, the herd instinct of most of us, and I hold my own hands up here to some extent, was that Russia would suffer pretty much from Western sanctions as the year progressed. We've seen, in fact, that has not yet significantly been the case in oil markets as yet. And it's oil, of course, where all the money comes from, far more than gas. So, I think India is doing what it is in its own national self-interest as it sees it in commercial terms, and I don't think a lot will change.
The other part of that equation over the weekend with the Iran-Saudi story, just to comment your thoughts on that, Neil, but also that Iranian oil exports have hit their highest level since the reimposition of sanctions. So basically, Iran is exporting whatever it can at this stage.
Yeah, sure. And, the cynic within me, who's become a bigger part of my personality as the years have gone by, takes the view that as prices were heading up in 2022, the United States was essentially turning a blind eye to higher shipments from Iran. We've heard very, very little, in public at least, I think, from policymakers about how egregious is Iran's behavior, busting sanctions, and we should be doing something about the people that are taking Iranian oil. Well, in fact, in some respects, you could argue that Iran's higher shipments, which we've seen not just recently, but for quite a while now, have, from the point of view of those people wanting to see lower prices in 2022, I think Iran's higher exports have been extremely convenient, if not necessarily welcome.
Let's go to the survey question and sort of give a sense of where this is going. As we've been discussing, will the collapse of SVP, Silicon Valley Bank, and now we should probably add the second bank, Signature Bank, be bullish or bearish for oil prices? Bullish in that it will signal the end of rate hikes, bearish in the sense that it could trigger this contagion that we don't see yet, or no impact in the end for oil prices. Bullish as the end of rate hikes, bearish due to contagion, 3, no impact in the end. It's a tough one, I have to admit. I wrote the question. Okay, I'll go there. Mike, where does this go from here? I mean, as we said from the beginning, it's Monday morning, obviously not Monday morning yet in the US, but it is early when it comes to markets. Markets are looking to rise now. Equity markets are looking to move up. The US equities, although the Asian equities are down this morning, sort of following on from Friday, but US equities already pointing upwards on the expectation now that this will trigger a Fed pause. Where do you think this goes this week?
Well, I think as far as this week, it could bounce initially, and that's what bear markets are supposed to do, especially when you get short to rip your face off. But I think what we're going to see is the S&P 500 bumping up to very good resistance around 4,000 and eventually go to 3,000 this year, which is a normal correction in the bear market. It'd be about 50% from the peak. And in a recession, the last 2 recessions, we had a 50% peak to trough. So trying to figure out the day-to-day, I think is too difficult. But what you're seeing, Sean, to me is the slow rollover of the long and variable lags. And remember, we had one of the biggest bond collapses ever. And what all these banks have in common is they were involved in treasuries with too much duration and they did not hedge. So to me, this is just the beginning. The next key steps were, let's leave this as a key fact, is typically the commodity market bottoms about 1.5 years after the first Fed ease. We're still talking about stopping the tightening. That's the key point I've been making for about 1 year now. This is the big reset and it's just getting started. So as far as bottoms in the market, let's use natural gas and lumber as good guides for commodities. I still look at corn is way too expensive. Copper is probably too expensive. And that's just in a typical normal U.S. recession. And right now, to avoid a recession, you have to shift to massive Federal Reserve and fiscal monetary easing. And we're so far from that. So long and variable lags, this is a 1-year anniversary. Expect markets to go down. And I don't want to be the doom and gloom. I just want to be pure facts. They said, well, usually what happens in this types of environment.
Omar, we also had over the weekend the bionic Aramco results, $161 billion of profit last year. It's following the trend of all major oil companies reporting bumper profits. But the interesting counter narrative to that is the Baker Hughes drilling index signaling 3 less drills last week in the US. I mean, it's only 1 week, but nonetheless, my point is you've got all of this money going into the oil companies, but they don't seem to be putting any of it in the ground and building up for that possible breakout upwards in prices rather than downwards, given the supply outlook being constrained. Your thoughts on that?
I hope we're not still talking about shale, because I don't know how many times I've said it. Shale is dead. It died a long time ago.
The parrot is dead.
It's still dead. Whatever you do, it's dead. Shale was born out of 0 interest rates. You can't get, there's no shale. Forget shale. Forget Baker Hughes. Forget looking at drilling. Forget it. It's dead. I agree with a lot of the stuff that Mike said. In fact, I'm actually more bearish than that. And I think I am doom and gloom. But also I wanted to say, isn't it interesting also? I don't know if you've been following this Nord Stream 2 story, like who blew it up, because the US came out and said, Seymour Hersh said the US did it, Biden did it. And then the US said, yeah, we got like some intelligence that says a pro-Ukrainian group rented this boat. And basically, seriously, 6 people went on this boat. And now the German papers have shown that basically they needed about 2,000 kilograms of explosive, and they couldn't physically fittest on the boat. So now they're saying, well, it could be that they used 2 boats, not just one. So again, this is, I mean, what I'm trying to show here is the pattern of basically, stuff falling off. It's like when you go out.
The king has no clothes, ultimately, is what we're seeing.
Yeah, you go to a party and you're all nice and whatever. You have a first drink, second drink, and then you're totally gone. I mean, stuff's falling off you. You're slurring your words. You can't get upstairs. So I think that's where we're at. I think that is the kind of mood that the market is in. So I think it's more of a mental thing, rather counting, 3 of these and 2 of these. And I think the mood basically is that way, lower.
Neil, last word to you with the survey result here. Bearish due to contagion. Nobody's going with the bullish as end of rate hikes. No impact in the end. Your thoughts on, I mean, this is a very sort of strange moment with the idea that, the European economy is still showing there's life in that old dog yet. The DAX of the German index is still moving in a fairly high levels. Generally full employment in the UK. All of these things seem to be coexisting with this somewhat Armageddon moment over the weekend. I'm just your thoughts from a European point of view, coming out of winter. Worst is over from an energy crisis point of view. That there's still life in the bucket.
Well, the worst is over for now. As far as the energy crisis in Europe is concerned, we'll have to wait and see as the year progresses. We don't want to get into weather forecasting because it's even more hazardous than forecasting rate hikes. So Europe is sort of humming along. There is high employment in most of the major European economies. That's certainly true. But there are all these uncertainties. But it does look as if, looking at the news feed overnight, that the European arms of the Silicon Valley Bank, I was listening to some British radio earlier this morning, it does look as if action is being taken to prevent contagion over in the UK. I don't know what the interest the bank has in other European economies, but I guess the regulators there, where there are interests, will be taking steps to prevent any contagion. So I take the view that unless there's something really deep and nasty and ugly down in the bowels of the SVB, it is going to pass, and it is going to be a sort of, not quite a shrug moment, but the actual event itself with SVB will not have necessarily immediate consequences. The 2 guys, Mike and Omar, it's just before 8 a.m. in the morning here, and I almost feel like going back to bed, putting the duvet over my head and hoping everything will go away.
And waking up on July 1st.
And everything will be nice, but hey. But no, they've made some very good points, and there's a lot of food for thought there.
And we haven't even mentioned that the top Chinese property developer, Country Garden Holdings, said this morning that it was going to post its first loss since 2007. There's another big shoe to drop in that Chinese property market, I think, that might make SVB look like a drop in the ocean. There's shoes dropping potentially everywhere. But is this a cookie in the coal mine moment, or is it an isolated, weird bunch of techies in Silicon Valley just playing too close to the wind? We'll have to wait and see. But as Omar said at the beginning, it looks inevitable that the Fed and the Treasury will do what they've become very used to doing, and that's bailing everybody out, building up the debt, and pushing it onto our grandchildren. All the best. Thank you very much. Oil prices trading a little bit down this morning. I correct myself. They're now up. They're now a little bit up. So they're deciding that actually maybe this is a bullish moment. Trading on Brent a little bit over $83. Thank you, Omar in Dubai, Neil in Paris, and Mike in Florida. Really appreciate your participation this Monday morning, 11 a.m. UAE time. All the best. Take care.